Hello everyone. I wanted to run through this AFR article that appeared last week quickly with you because it covers quite a few of the things that we're going to be going through in the next 10 weeks. So I just thought it'd be useful just to give you a sense of where we're heading and what we're going to be looking at over the course of the term. So the first thing we're looking at is CSL's results that were announced last week. What we see here is, first up, they've delivered a December half profit. So first thing I wanted to highlight here is that the market focuses on delivering a profit rather than cash flow. So the first number that we highlight is a profit number. We'll come back and think about why that might be the case, because we know from finance that we always hear that, look, cash is king and you can't trust accounting profits because managers can manipulate them. So I guess that calls into question, why would the AFR and why would financial journalists generally be highlighting profits rather than cash flow? Second thing that I wanted to highlight is we're told that the profit came in just below market expectation. That's also going to be something that we'll be focusing on in our accounting analysis. Market expectation is really a shortcut for security analyst consensus earnings forecast is really what that means. In other words, what were the analysts expecting CSL to report? The security analyst consensus forecast is certainly one of the benchmarks that we know managers try to hit when they're trying to determine or come up with their final results. So we've got earnings and we've got market expectations. We also focus about the way in which strategy is going to get reflected in the financials. And the big concept here is investors are worried about a fall in margins. And also, we've got the CEO confident that margins are going to increase. So again, we've got to focus here on profit margins. Again, we'll be thinking about the way in which a business's strategy gets reflected in the key financial metrics. Margins are going to be one of those. The next thing that we want to highlight is further down in the article, when they're talking about the results that Macquarie Bank were announcing. One of the key metrics that we'll be thinking about is a business's return on equity. So that's net income divided by shareholders' equity. It's the rate of return that shareholders get. And this is from an accounting perspective, not a market perspective. This is unrelated to share price. So the question that's being raised here is, what's the appropriate return on equity for the long term for a bank like Macquarie? Is it 14%, which has been the long-term average over 18 years, or is it closer to 10% in the first half of the financial year? So a key consideration that we're going to have over the course is, to what extent do the industry conditions and the business strategy give us a guide as to what might be a reasonable return on equity, or a related measure that we'll be looking at, a business's return on invested capital? So what have we got here? Earnings seem to be important because that's what the analysts and the media focus on. We've got expectations are going to be important in terms of determining the market reaction to an earnings announcement. We've got key metrics like margins. We've got key metrics like return on equity. So as I said, this is kind of a nice little article because it captures quite a bit of what we're going to be looking at over the course of the term.